All right, guys, I can't wait to talk to you about one of the most boring subjects on the planet, and it's taxes. And by the way, we're not going to talk about you paying taxes and paying more taxes and dealing with all kinds of taxes. We're going the other direction. We're going to talk about how to save a ton in income taxes. So let me tell you one of the top 3 conversations that I have with successful entrepreneurs, successful investors, especially if they're like CEOs, business owners, sales leaders, founders, physicians, successful attorneys, etc. When they decide that they should consider owning multifamily real estate, you would think that a lot of our conversation would center around rate of return, cash flow, properties, location, etc. And yeah, some of our conversations do orbit around that, but you want to know the one thing that our conversation always orbits around with all of these investors? Taxes. One of the main reasons that they contact me and want to explore working with me and being one of my partners, frankly, they got to save some income taxes. They have had someone tell them, they've said, look, you're getting pretty damn successful here. You've really expired all of the ways, whether it's through your business, whether it's through some other ways where you can be saving income taxes, because there's 2 ways to build your wealth. The one way is, of course, being industrious, working hard, whether you own your own business, you're a sales professional, physician, attorney, whatever it is, it's through business and through ambition. But the other way, the other lever to pull is you got to look at paying as little taxes as possible. Okay, legally, of course. That's the other lever. So not surprisingly, one of the top 3 conversations I have with successful investors, CEOs, entrepreneurs, founders, etc., have to do with, Darren, I got to be saving some income taxes. I'm paying way too much. Help me out. Now, before I go any further, I got to mention I'm not a tax attorney. I'm not an accountant. I'm not a financial advisor. And so I'm not giving you advice on what you should do. But what I am doing is telling you what I've seen from the sidelines, what some of my top investment partners have been able to achieve in tax savings by owning multifamily real estate. And if tax savings, again, is something you're serious about, you got to keep this in mind as I go through some real simple examples of how to do it. And I'm going to show you how to do it in 2 ways. One way is the near term. We're getting the whiteboard out here, right? The near term. What can I be doing the next year, 3 years, 5 years in order to save as much in income taxes as I possibly can? And the other is long term. Okay, what can I be doing 5 years from now, 10 years from now? And how can I use multifamily real estate to bridge that gap between short term and long term so I have a tax savings plan for 3, 5, 10, 15, maybe even up to 20 years? Okay, let's dive into it, but let's start with short term. Okay, so I'm going to put a line down the page here. This is our short term side. I'm going to put ST here for short term, and I'm going to put LT there for long term. All right, let's get into short term here real quick. So what multifamily real estate does in the beginning is not a secret. So let's go over it. First of all, I get the income from the property. I own the multifamily property. And by the way, this is whether you're active or passive. Now, I'm not talking about owning a REIT or stock in real estate. I'm talking about directly owning real estate, maybe as an individual, as a partner, maybe you're in a syndication. That's what I'm talking about. What I'm not talking about is owning stock in a company that owns real estate. You can't have any of these benefits if you go down that road, my friend. You've got to directly or indirectly own the real estate, which cannot be owning stock in a company that owns real estate. Okay, are we clear? All right, good. Now, our properties that we own together, we collect income from the properties in the form of rent, right? Okay. Then we got our expenses. Okay, so what are our expenses? Typically, property tax, insurance, maintenance, payroll, Lawn care, snow removal, utilities, etc., etc., etc. Right? So we collect our income, we pay our expenses, and then at the end of the year we end up with net income. Okay? Net income. So we collected our income, we paid our expenses, here's what's left, net income. Some would call it EBITDA. We're going to call it net income. NOI is what a lot of people would call it. So we've got our net income. So our property has made a profit, a profitable net income. This net income is the base, the foundation for where the tax conversation starts. In other words, how much tax, income tax, will this property pay? And it's a lot of it's, first of all, based on that net income. So this is where the conversation starts. However, the conversation gets interesting from the very start. What do I mean? Well, when you've got your net income that the property produces, and that starts the conversation, the start of how much money did the property make that we can look at from a tax standpoint in extricating income taxes from. Okay, how much is that? The net income tells you that. However, here's what we get to do with multifamily real estate. We get to subtract from that net income two big expenses. The first is interest, loan interest. So similar to some of you owning your own home or condominium, every year you probably write off that interest that you're paying on that loan. We get to do the same thing with multifamily real estate. Okay? So that's a nice little bonus. Now our net income, after we take away interest, is lower, right? It's lower. But then we get an additional benefit, an additional bonus with multifamily. Now we get to deduct depreciation. The government, in its wisdom, allows us to, because of the risk as owners of multifamily, allows us to take depreciation as an expense. Depreciation, wear and tear of the building, components, the parts of the building, etc. And we get to deduct that every year. Now, the interesting thing is we don't get to just deduct the building and the structure. We get to deduct things like appliances, stoves, refrigerators, washers, dryers. We get to deduct things like mechanical systems, furnaces, air conditioners. We get to deduct things like floor covering, okay? We get to deduct ceiling fans. We get to deduct the pipes that run the gas, the electricity, the water through the building. If we buy a bike rack, and we got bike racks on the property, guess what we get to depreciate? We get to depreciate bike racks. So where does this go? When we legally maximize our depreciation schedule, all of a sudden this net income here, which is 9 times out of 10 a positive net income, property's doing great, it's kicking butt, things are going great, we get to take interest off of that, depreciation off of that, then what happens? The property has a negative net income. Darren, how can a property do well if it's got a negative net income? Guys, follow me on this. It didn't have a negative net income. Okay? We collected the income, we paid the expenses, and we put this net income in our pockets in terms of return on investment. And we might have taken a piece of that, maybe put it in reserves, sure. We might have taken a piece of that and maybe made some capital improvements, sure. But we've put the large portion of that in our pockets in terms of return on investment. So we're done. But on paper, when we file our tax return, we get to deduct interest, we get to deduct depreciation, so that in many cases we have a negative net income. That's just absolutely crazy, isn't it? By the way, this is all legal. This is not anything that's, shady. This isn't a scheme. This is all legal. Okay? So, let me share something with you regarding one of my partners that I noticed, okay? When we were getting our tax return work done and getting all of our partners, all of their tax forms, one of our partners showed a loss. We had a really nice positive net income, good return on investment, good money in pocket, good return, property's doing really well. He shows a negative $235,000 He showed a $235,000 loss. $235,000 loss on his portion of our company's tax return. Now I want you to think about this for a second. He gets that $235,000 loss now basically pulled over to his tax return to now apply to his personal tax return. Think about that. He gets to pull over that $235,000 in legal losses, even though the property made money, he put money in his pocket, $235,000 loss to now apply to his personal tax return. And do you think that he appreciates applying a legal $235,000 tax loss to his adjusted income on his tax return? Duh, yeah. And guys, short term, this is what will happen year after year after year if you have a smart operator and you're teamed up with people that understand the importance of this. Now, every year it might be more than his $235,000, it might be less. And over time, when you pay less interest, of course, when you're making those loan payments each year, you pay a little bit less interest and less interest. So this 235 over time might be 210, then maybe 150, and then maybe 140. But look, guys, this is going to be a consistent theme year after year of pulling legal tax losses, applying them to your personal tax return, and I'm not going to say eliminate taxes, but think how much less in taxes these investors are paying by using this easy, short-term solution by owning quality multifamily properties. And just think doing this year after year after year, how you can exponentially grow your wealth. Do you see why this is one of the top 3 conversations I have with people when they contact me? Yeah, you can see. All right, we've talked about the short-term benefits, right? And we can dig more into that. Heck, we can have a 3-hour seminar just on that, but you get the point. But now we're going to talk long-term. And this is, in my opinion, where it's even more interesting. It's even more interesting. Okay, so let's set the stage here. You've done this short-term thing here that I've described, this short-term benefit. Let's say you've done it every year for 15 years. Okay, so we're 15 years down the road. We have a buyer that's approached us, and they've made us an offer that we just can't refuse. The number's huge. We'd be ridiculously stupid if we turn this offer down on our apartment property. They want to buy it from us, and the offer simply is an offer that we can't refuse. It's that good. Okay, but there's one problem. That problem is if we take that offer and we sell that property, what's the one thing we're going to have to then pay? We've been kind of avoiding paying it for 15 years, but if we sell, what's the one thing we're going to have to pay? That's right, taxes. Capital gains taxes, right? Oh, geez. You might be thinking, okay, Darren, yeah, you've kind of rode that gravy train for 15 years. Now you're going to sell it. Now it's time to pay the piper, dude. You can't. The death and taxes, man. Death and taxes, it's always there. Maybe. But in most cases, my partners and I, even when we sell, we don't pay taxes. We defer. We continue to defer taxes. And you're probably wondering, Darren, what in the hell are you talking about? How is that possible? Somebody comes up to you with a great offer, you accept it, you get a great price for your property. You're still gonna, even if the number's outrageous, you're still gonna have to take some of that and pay taxes, right? No. Why? Because real estate is the only investment that allows you to sell, and as long as you take those sales proceeds and you put it into another investment property, you know how much in income taxes you pay if you do that right? Zero. So I want you to think about this. Let's say you've owned a successful trucking company for 20 years. Finally time to sell. When you sell it, what are you going to be writing a check to? Who are you going to be writing a tax check to? Capital gain. Uncle Sam. You have a successful law practice. You sell that law practice. you're going to be writing a capital gains check out to Uncle Sam, okay, etc. You get the point. But when it comes to real estate, you sell a successful real estate property for a lot of money, you don't have to write that check out. You get to take those taxes and defer them into that next investment property. So if we have a 100 unit property here that we've owned for 15 years and we've done our short-term tax work each and every year, it's finally time to sell it. We're going to cash in. What can we do? We can take the sales proceeds from this 100 unit property. We can buy a 200 unit property. We can buy a farm. We can buy some development property. We can buy an office building, shopping center, etc. As long as we take that money and we apply it to another investment real estate property, guys, we pay zero in taxes. Guys, I have investment partners that use this strategy and they never pay any taxes. They just keep deferring, saving, deferring over and over and over again. They never pay taxes because what they do is they own these properties and they make it part of their estate until they pass away. And when your heirs get that property, when you pass away and those heirs get your property, they get what's called a stepped up basis, which means they get your property and they start from scratch just like they purchased the property that day. And if they decide to sell, you know how much in capital gains taxes they have to pay? Almost nothing. Think about this. If you own the right multifamily property for 20 years, let's say, 15 years you do this, you do what's called a 1031 exchange. That's what this is called. You do a legal tax exchange where I take my proceeds after we sell, big profit, we take that big profit, we roll it into some other investment real estate, and you still pay zero taxes. 20 years, you haven't paid hardly any taxes. In some cases, none. In some cases, maybe a little. You get to defer capital gains taxes for really as long as you want. What a great 15 or 20 year plan. So let's kind of come full circle here. We talked about short term and we talked about long term and how you can save. You know, when I originally was talking to you on this episode of this podcast, if you remember, I started out by saying 50%, heck, maybe even up to 50% you can save on income taxes. And you're probably wondering, well, come on, Darren, what are you talking about? Now do you see, by combining the short-term plan of every year maximizing those deductions using interest, using depreciation, accelerating that depreciation, again, doing all of this legally, right? We can do it and we maximize it, and as part of what we do with our partners, that's what we maximize. Then we get to a point where maybe it's finally time to sell, or we get a big offer on the property, but geez, you know, we've done so great, Darren, and can we still defer taxes? Yeah, we can, because we can go with a tax-deferred 1031 tax-deferred exchange. We can take those proceeds, go into another property if we want to, as long as it's investment property, okay, and continue to defer taxes really almost as long as we want. Guys, there is no other investment that does this. Again, I'm not a financial planner. I'm not a CPA, I'm not a lawyer, I'm none of that. But I have dealt with billions of dollars of apartment communities over the last 30 plus years, and with partners that continue to leverage what's right there in front of them to not only get a great return on their money, but to maximize their wealth exponentially by avoiding legally paying income taxes, or avoiding paying as much in income taxes as they possibly can. All right, guys, if you have any questions on this, you want to dig deeper regarding this episode of the Heartland Multifamily Show, go ahead and go down in the show notes. You'll see I've got some links and some additional information there that you can use, maybe some resources you can use to dig into this a little bit more. I think you'll find some of that information Very, very helpful. Of course, comments, would love to hear from you regarding what I've gone over here. I would like to have some dialogue with you. Give me some of your biggest takeaways. What are some of your biggest takeaways that you've had from what we've gone over here together? All right, look, if you're not implementing this, what in the hell are you waiting for? Implement it yesterday. Get this going. Make it part of your financial picture. And good luck when you do. I can't wait to hear your success stories on implementing this and you letting me know exactly how it went for you. All right, take care. We'll see you